Learning Objective 17-6 is understand and explain basic budgeting concepts in governmental accounting. And budgets are used in governmental accounting to assist the management control, provide legal authority to levy taxes, collect revenue, make expenditures in accordance with the budget. A budget in government accounting is like a commercial accounting, is like a budget in financial and managerial accounting, in that this is the government's plan. But there's a big difference in that in governmental accounting, a budget is a law. And everything, the budget is the most important document of the year by far. That says what you can do and what you can't do. And therefore, adherence to the budget is extremely important. It's not simply a plan and you hope to stick to it. It's much more serious than that. You need to stick to your budget because it's a law. So governments have two types of budgets, what's called an operating budget and a capital budget. Capital budget would just be for a capital project fund, but the operating budget would cover all of the other governmental funds. And the terms that we're going to use here are what's called an appropriation. This would be a decision to spend money. It's really a budgeted expense. It's called an appropriation. And annual budgets for general funds and special revenue funds are actually recorded in the general ledger. So it's very different. In financial accounting, budgets are something that are done on a spreadsheet or in separate set of software. But sometimes more modern systems, SAP systems, enterprise-wide systems, are going to also keep track of your budget for you, but they don't really go into the general ledger. Whereas in governmental accounting, they do go into your general ledger. You might do, and it's optional, is to put, oops, I just spilled soda all over my desk here. The other, but I'm going to keep on going with my video. Even though there's soda spilling all over, I'm going to keep on going. So anyway, it's optional to do this for the capital projects budget and the debt service funds. Encumbrances. Introducing encumbrances. What encumbrances are commitments related to unperformed contracts for goods or services. Let me explain. You're going to spend money on something big, and it's going to take a while to complete the transaction. So for example, let's say you're buying a new piece of equipment and you have to order it in advance and you're not going to receive the equipment until next year. When you make the commitment to purchase the equipment, that becomes what's called an encumbrance. This is going to come out of next year's budget. But you've made this commitment, and the encumbrance is recording this commitment in your financial statements. Actually, it's going to appear in your financial statements, and it's going to appear in your general ledger too. So, an encumbrance is kind of like if you've worked within companies, you've seen companies issue purchase orders. A purchase order, in a way, is an agreement to buy something, but it's not recorded as an expense or as an expenditure yet. It's not an asset yet because you haven't taken delivery of it. So purchase order has a level of commitment to it. You will probably be paying to purchase this item, but because you have not yet purchased it, you've not yet received it, it doesn't go into your financial statements. Governmental accounting has a different way of dealing with this, and that's that if they issue a purchase order for something large, it's got to be large. If it's a small item, it's not an encumbrance. But if you've issued a purchase order for something large, and it could even be where you're going to purchase it this year, then you're going to record an encumbrance on your books. And we have special ledger accounts that are used for those too, and they go right into the general ledger. And budgetary entries are kept separate from your reported operations. They don't affect revenues and expenditures and so on. But they do go into the general ledger and they're memorialized in that way. And the book has a nice little formality here in that when they record a budget in the books, they use capital letters for the account names. Expenditures needs to go through 4 different stages. Sometimes they go through just 3. They go through what's called the appropriation. This is budgeting that the government can actually spend the money on this item. If it's large and it takes a while to receive the order, it's going to be an encumbrance. You're going to record an encumbrance. Then when you actually receive the goods and you take on the liability to pay for them, that's an expenditure. And then finally you pay for it. So let's try an example. Burb City approved an operating budget for the general fund of $900,000 in revenues and $850,000 in expenditures. So this is really cool. We're going to record it in capitals, and when we record budgetary entries in the general ledger of a governmental fund, we're going to switch the debits and the credits. It's really cool how the numbers work out later on, you'll see. But we're going to switch the debits and credits. So revenues are not going to have budgeted revenues, which are called estimated revenues. They're going to have a debit balance. And budgeted expenditures, which are called appropriations, are going to have a native credit balance. So you're going to debit, and I'm going to put it in capitals because it is a budgetary account. You're going to debit estimated revenues control for $900,000, and you're going to credit appropriations control, because that's what budgeted expenditures are called, appropriations of $850,000. Now, what's this word control? In general ledger and old-fashioned bookkeeping lingo, control is when you have a master account and then you have what's called subsidiary accounts. So a control account, the classic example is accounts receivable. Accounts receivable control would keep track of total accounts receivable. Accounts receivable subsidiary accounts would be all the individual accounts receivable that make up that control account. So you kind of think of it as like a tree, and the trunk is the control account, and the branches are all of the subsidiary accounts. And all of the subsidiary accounts need to add up to the control account. So why is that relevant here? Because we say, and this is just how the book does it, I think, estimated revenues control will be total revenues you expect to take in. But then there are going to be subsidiary accounts that make up this control account. So you could have property tax, sales tax, this tax, that tax, the other tax, all these different taxes. Each one is going to have their own account called subsidiary accounts. And then they got to add up to that control account. Same thing with appropriations. You're going to have lots and lots of appropriations for different things. What they're doing here in the book is they're simplifying this, and they're just saying appropriations control, and you should know what all the other appropriations are. They're all listed in the budget. So in reality, this is going to be a huge journal entry, because they're going to have, they could do it this way, or they could do it with all the subsidiary accounts. The difference between these of $900,000 minus $850 of $50,000 is going to go to the account budgetary fund balance unassigned. And that means that you have $50,000 to play with. Now let's talk about unassigned and spendable and all of this other kind of stuff. The question is always going to be, how much money do I have to spend? So what you would always do is you'd want to look at the total amount available, total appropriations, minus encumbrances, and the sum of encumbrances and expenditures. And that would be the amount of appropriations that you have left. So let's say they approve $850,000 as they did, and so far they expended $400,000 and they've got $30,000 in encumbrances. The idea of the encumbrances is that this is going to become an expenditure. So really, they've spent $400,000 and they've committed themselves to spending another $30,000. So they spent $430,000. So that would mean they have $850,000 minus $430,000, $420,000 left to spend. That's how much you've been authorized to spend based on this appropriation.